Our new framework says that we will seek inflation that runs moderately above 2% for some time after we've had a shortfall of inflation. And it also says it commits us to not raise interest rates just because the labor market gets strong. And those things, I think, will be good for the labor market over time. Again, I would just say, as it relates to the bond market, I'd be concerned by disorderly conditions in markets or by a persistent tightening in financial conditions broadly that threatens the achievement of our goals.
And I understand why you wouldn't want to comment on a specific level of rates, even if the level of rates isn't a problem. Was the speed with which real rates adjusted over the last week problematic in your view?
It was something that was notable and caught my attention. But again, it's a broad range of financial conditions that we're looking at, and that's really the key. It's many things, and we want to see, and would be concerned if we didn't see disorderly conditions, orderly conditions in markets, and we don't want to see a persistent tightening in broader financial conditions. That's really the test. It's not appropriate to isolate one particular interest rate or price. It's more of a broader assessment that we make.
I guess what I'm wondering is the market now believes the Fed will raise rates earlier and faster than it thought a week ago. Are you saying that's consistent with your outcome-based policy guidance and with your new framework?
It's going to depend entirely on the path of the economy. So I laid out the conditions upon which we would consider raising interest rates, and that's labor market conditions that are consistent with maximum employment, which is, that's a big thing to get to, and it will take some time to get there, right? Inflation sustainably at 2% and inflation on track to run moderately above 2% for some time. So those are the conditions. When they arrive, we will consider raising interest rates. We're not intending to raise interest rates until we see those conditions fulfilled. And so that it's really the timing will depend entirely on the fulfillment of those conditions. And as I said, again, if I've told you that we think we're likely to see inflation move up during the course of this year through really two things. First, the base effects I mentioned, but also just kind of reopening effects where businesses will be potentially hit by a lot of demand as the economy recovers, which is a good thing. But you could see bottlenecks, you could see prices moving up. We're inclined to see those as transient. And there's a difference between a one-time surge in prices and ongoing inflation. Ongoing inflation, where prices go up year after year after year, tends to happen when people's psychology becomes that they believe that's what will happen, and they have no faith that the central bank, frankly, will prevent that from happening. So, as I've said, the key thing is to keep longer run inflation expectations anchored at 2%. If that happens, then a transient increase in inflation will not affect inflation over a longer period. And we intend to use our tools to keep inflation expectations anchored at 2%, which gives us the ability to do all of the things we do when the economy is weak.
It could take months, though, for the data to contradict or validate this narrative about transient inflation. And obviously, investors are twitchy right now. Do you think your guidance is too vague right now to be properly understood by investors?
I'm trying to make it as clear as possible. And I went through, the guidance. I think the guidance for the tapering asset purchases has an element of judgment in it. But I've also said that we will, well in advance of any decision to consider tapering asset purchases, we'll communicate about our sense of progress towards substantial further toward the goals, substantial further progress toward our goals. So we're not looking to surprise people with that. And as far as the rate liftoff guidance, it's pretty specific. And as I said, it will take some time to get there. If you think about it, you've got to have a very strong labor market and inflation performing in line with it's a picture of an economy that is all but fully recovered. The sooner that happens, the better. But I would say realistically, that's going to take some time.
And as we sit here today, do you think the hope of a brighter outlook you've discussed here might lead to substantial further progress being achieved this year?
Again, I've been so far been able to not reduce it to an estimate of time. I mean, that will come, I think, when we can see that. Right now, we haven't been making much progress. I mentioned 29,000 jobs per month for the months of November, December, and January. So, and spending was maybe a little better than that, but in the job market, you saw a real slowdown at job creation. That wouldn't get you to maximum employment anytime soon. That's just not enough. So, I do expect, and many forecasters expect, that there'll be a pickup in job creation. We'll have to assess that when it comes. I don't want to be making, but again, I think realistically though, it's March, and we're going to start. Presumably in the next couple of months, we'll start to see stronger employment, and we're going to want to see substantial further progress in both maximum employment and stable prices. That's going to take some time. It just will take some time because you've had 3 months now where you didn't make much progress. So we've got to get going and start making it again. And for us to assess that and signal forward, it's going to take some time.
As you noted, the Fed is buying $120 billion per month in Treasury and mortgage securities. You've been saying for the past year that your asset purchases are designed to support market functioning. Have you seen anything in the Treasury market that suggests a need to lengthen the maturity profile of your purchases?
So we think our current policy stance is appropriate. As I mentioned, the federal funds rate is at the effective lower bound, which is our technical name for zero or close to zero. We provided really strong guidance about the conditions we need to see before we considered raising it. We're buying $120 billion in treasuries and mortgage-backed securities across the curve, and we'll continue at least at that pace until we see substantial progress toward our goals. Financial conditions are highly accommodative, and that's appropriate given the ground that the economy has to cover. It's always the case that if conditions do change materially, the committee is prepared to use the tools that it has to foster achievement of its goals.
Well, and if there were some kind of rate move that you felt represented a threat to your outlook, what would you do to address it?
Well, that's a sort of hypothetical situation. We would use our tools. It's hard to say in the abstract, but we would use our tools as appropriate to foster the achievement of our goals.
There's been some discussion in recent days. It's gotten a lot of attention. The idea of selling bills or letting bills run off of your portfolio to address a collateral squeeze in money markets. Is that something you think needs to be considered at this time?
Nick, as I said, I wouldn't want to speculate. Really, I'll just say if conditions do change materially, we'll be prepared to use our tools in whatever way is appropriate at time to foster the achievement of our goals.
I know a lot of this talk about inflation and interest rates can feel abstract, and so I wonder if you could put into plain language what the practical effect is of the changes the Fed has been making over the last year to your framework. What does it mean for everyday workers?
Great question. So I guess I have to say, for a long time, and when I was entering the job market years ago, when we had low employment, we had high inflation. So when the job market got good and tight, employers were actively seeking people, and there were plenty of jobs, inflation would be moving up, and therefore the central bank, the Fed, would be raising interest rates to cool off the economy. And I would say 50 years ago that was appropriate because there was this tight connection between unemployment and inflation. More recently, though, that I think the Fed established its credibility several decades ago on inflation, and since that time, the connection between having a lot of people out of work and inflation under control has gotten very, very weak. So our new framework very explicitly takes that takes that in, that new learning, that new understanding, and says that we won't raise the interest rates to cool down the economy just because unemployment gets lower, just because employment gets high. We're going to wait to see signs of actual inflation or the appearance of other risks that could threaten achievement of our goals. And we've seen that the economy can sustain very low levels of unemployment without inflation. So what does that mean for job seekers? It should mean that the job market will be stronger over time. We also saw the terrific social benefits of a very strong job market during 2018, 19, and the early part of 20. We saw workers at the low end of the wage scale getting the biggest increases. We saw labor force participation moving up. So people who might have given up on finding a job found a job, and people at the margins of society, maybe coming out of prison, things like that, got jobs. And there was really a lot to like about a very strong labor market. So, we're really, really committed to getting back to a very strong labor market. And the strong anchoring of inflation expectations, the inflation dynamics that we have give us the ability to do that. But it does require that we remain committed to keeping inflation expectations anchored at 2%, and we will do that.
Of course, some prominent economists in the last couple of weeks, as you know, Larry Summers, Olivier Blanchard, are saying that policymakers have maybe grown too quick to conclude from recent decades that low unemployment is no longer inflationary. Are they right to worry about this right now?
Well, so many people, particularly people who are now entering the job market, will not have lived through high inflation. And high inflation is a very bad state of affairs, and it hurts people the most on fixed incomes and lower incomes who have less wealth to draw upon. So inflation was very high when I was in college and coming into the job market. So it's really not something we want. But I would say, at the Fed, we are well aware of the history and how it happened, and not going to allow it to happen again. It was a situation where the Fed didn't step in when it should have, when inflation pressures were building. Not at all the current situation. Inflation is currently running below 2%. It's running at 1.5%. But we're very mindful of what happened in really the 1960s and 1970s, and determined not to repeat that mistake. But you have to differentiate, though, between one-time price effects, such as things that happen around the reopening of an economy, not something we have much experience with, and just the sort of, when I say base effects, it's a technical term, you look through that, it's not really signaling anything about inflation. So, I mean, we're very mindful, and I think it's a constructive thing for people to point out potential risks. It's always constructive. I always want to hear that. But I do think it's more likely that what happens in the next year or so is going to amount to prices moving up, but not staying up, and certainly not staying up to the point where they would move inflation expectations materially above 2%. That would take, the public would have to come to believe that that's the new policy, that's the new reality. And I really don't think that, a couple of quarters of prices, or even more than that, but prices being above 2% would change the psychology, particularly in a world where inflation has been the problem for the last decade in all of the major advanced economy countries. They've been facing low inflation because of these global disinflationary pressures, which haven't gone away, and they're not going to go away overnight.
So it's been a year really since we began to face this pandemic, at least in the United States. You announced your first of 2 emergency rate cuts a year ago yesterday. And so as we mark that anniversary, what are 1 or 2 of the most important lessons you think we've learned from this economic crisis?
Yeah, we've been thinking about that a lot. You're right, we're sort of going into the anniversary of that extraordinary period. So the first thing is, and we really implemented something that we learned from in the last crisis, the global financial crisis, and that is that we needed to move quickly and powerfully with our tools and not hesitate. And we really did that this time, and so did Congress, by the way. The CARES Act passed within a month, really, of the pandemic starting to get going. We had very strong fiscal policy in the original CARES Act, unanimously passed by Congress, and we cut rates twice. We started asset purchases to support market function at an unprecedented level, and we also announced the opening and opened facilities to replace, to assure that the flow of credit to households, businesses, and municipalities in the country. All of those things were in place very quickly. So thing one is, when you have a real crisis, attack quickly and don't hold back. Thing two is don't stop until the job is done. So there's a real sense that in the last crisis, really fiscal policy pulled back and became tight, and it led to a very long, slow recovery. So we're committed to using our tools and, staying on the playing field with our tools until the job is really done. We're committed to that. And Congress, of course, has come with quite strong fiscal policy. And so I think, we're in, if you look around, we're in the place we're in now. There's still a lot of pain out there, and more than 500,000 people have lost their lives to the pandemic. But compared to the economic scenarios that we were contemplating a year ago, this is, it's good to be where we are, and particularly with the vaccines now. No one thought we'd have vaccines within a year, less than a year. And now vaccination is moving at a good pace. We really are looking, if we can just decisively end the pandemic, we could get back to normal and avoid a lot of the longer term damage that we were concerned about happening. But we haven't done it yet. We haven't succeeded in this yet, but we're right there. I think there's, if we can, the next couple of months will be very important on the pandemic. If we can keep making progress, that's what will help the economy more than anything.
And of course, last year you talked a lot about the need for fiscal policy, that is government spending to engage. It came through at the end of the year with $900 billion. Now it looks like we may get something, a few shades less than $2 trillion. Is this going to be too much too fast?
It's not our job. Our job as assigned by Congress is to use our tools to foster the achievement of maximum employment and price stability. We're not the Congressional Budget Office. We don't make assessments of, and we don't play a role. We're not up on Congress testifying on this or that fiscal policy. We're not in the discussions or the negotiations. It's just not our job. So I wouldn't comment on this particular fiscal policy. It's just, we have this precious independence the Fed does from political interference in our decisions. And, the other side of that is stick to your job, stick to your knitting, which we try to do.
Yes, we've heard that from you a few times before. Since we are here talking about jobs and careers, you said recently that you love your job and your term as chair is up in less than a year. Would you like to serve a second term if it was offered?
I have nothing for you on that today. My focus is on, the current challenges that we face and doing my job. There's a lot left to do. We have a lot of ground left to cover, and good reason for optimism. I mean, the last maybe lesson would be, even in terrible times, try to take counsel from your hopes as well as your fears, because, when in March and April of last year, but you saw the way the people responded and the way, the response, and then where we are, it's really, we should never sell ourselves short. And so I would just point out that it's good to be optimistic, but nothing new for you on that topic.
Well, on that note, we look forward to the day when we're able to have events like this in person again. But notwithstanding that, we're honored to have had you join us virtually today. So thank you, Chair Powell, for a great conversation.
Thank you, Nick.
And also thanks to our audience following online at WSJ.com and on Twitter.